When you start shopping for a mortgage, lenders will aggressively push two numbers in your direction: the headline interest rate and your monthly payment. Relying on these two metrics to make your decision is a massive mistake. Both of these figures are incredibly easy for a lender to manipulate on paper. They are designed to look as low as possible to get your signature on the closing documents. A lender can shrink your monthly payment by simply stretching the loan out over 30 years, so the principal barely moves. Or they can buy down your interest rate by burying heavy upfront fees in your closing costs. Neither the rate nor the monthly payment tells you the actual cost of the loan. You can secure the lowest rate on the market and still end up bleeding cash. This comparison table breaks down two identical $300,000 loans. Loan A offers an attractive 6% rate. Loan B sits higher at 6.5%. But if we check the math at the 4-year mark, the loan with the higher interest rate actually comes out about $3,000 cheaper overall. The reason is hidden in the closing documents. To get that clean 6% on Loan A, the lender required heavy upfront fees. Over those first 48 months, the amount you save on interest doesn't even come close to covering what you paid on day one. To accurately judge a mortgage offer, you have to measure it by its total cost over your actual holding period, the exact number of years you realistically plan to keep the house before selling or refinancing. The objectively cheapest loan on a 30-year timeline is rarely the cheapest loan on a 5-year timeline. Finding that true cost requires placing every lender's quote on an identical foundation. You have to run the math using the exact same loan amount and the exact same loan term. The MiniWebTool mortgage comparison calculator is built specifically for this. It strips away the marketing noise and runs a strict side-by-side analysis of your competing offers. When you enter your numbers, leave out property taxes and homeowners insurance. Those external costs belong to the local government and your insurance broker. They will be identical regardless of which lender you choose. This calculator interface is designed to isolate the variables the lender actually controls. We are exclusively comparing the principal, the interest, and the lender fees. By forcing every quote onto this equal footing, you strip away the optical illusions. The hidden variables are exposed, and the actual cost difference becomes a simple matter of math. One of the most common variables you will encounter is the option to buy discount points. This is a voluntary fee you pay at closing to permanently reduce your interest rate. Let's run a standard scenario on a $300,000 loan. You agree to pay $4,500 at closing to purchase 1.5 discount points. The upside is immediate. Your monthly payment drops. If you maintain this specific mortgage for all 30 years, that $4,500 investment will save you over $35,000 in lifetime interest. This line graph plots that $4,500 upfront cost against monthly savings. The cost intersects directly with your savings at exactly 46 months, your break-even point. Sell before month 46 and you are in the red. Hold it longer, and every subsequent month generates pure profit. The risk is entirely tied to life's unpredictability. Job relocations, shifting family sizes, or drops in market rates frequently force homeowners to move. Purchasing discount points isn't a universally smart savings tactic. It is a strict financial wager that your current living situation will remain perfectly stable for years. Beyond points, deciding between a 15-year and a 30-year term is the most financially impactful choice you will make at the closing table. This side-by-side bar chart shows the total lifetime interest paid. Compressing the timeline into 15 years avoids hundreds of thousands in interest. But because you retire the principal twice as fast, your required monthly payment shoots up drastically compared to a 30-year schedule. That high payment locks up your liquid cash flow. If your income dips or unexpected expenses arise, a rigid 15-year payment structure can quickly choke your monthly budget. You can navigate this by structuring a 30-year loan with biweekly payments. This gives you the safety net of a lower required payment with a built-in mechanism to accelerate your payoff. By paying half your normal mortgage amount every 2 weeks, you end up making 26 half payments a year. That equals one extra full payment annually, applied directly to the principal. On a 30-year loan, that simple cadence shaves off roughly 6 years and saves tens of thousands in interest. The math rule is absolute. Minimizing total interest always demands a higher output of capital, whether you pay it via upfront fees at closing or via heavier payments every month. To help consumers compare these upfront fees and varying rates, Lenders are legally required to disclose the APR, or annual percentage rate. It absorbs your origination fees and points, recalculating the loan as a single combined percentage. When comparing identical loan terms, checking the APR is an excellent way to spot lenders hiding massive origination fees behind artificially low interest rates. But there is a trap baked into the math. The APR calculation assumes you will stretch those upfront fees across the entire 30-year lifespan of the mortgage. This matrix tests APR on a 5-year timeline. Comparing a low-rate, heavy-fee loan against a high-rate, zero-fee loan, the high-fee option fails entirely. Selling at year 5, you haven't spread costs over 30 years. You've absorbed them 6 times faster, causing effective costs to spike. If you know you are moving within a few years, trusting the lowest APR is a catastrophic miscalculation. It will point you toward a heavy fee loan that will ultimately cost you money. Optimizing your mortgage does not require a crystal ball. It requires identifying which of 2 distinct buyer profiles you belong to. Profile 1 is the stepping stone buyer. You plan to sell the property or refinance the loan within 5 to 7 years. If you are a stepping stone buyer, you should heavily weight the plain interest rate, reject discount points, and actively avoid lenders carrying high fees, because you won't be in the house long enough to recoup the cash. Profile 2 is the forever home buyer. You are locking in a location and plan to stay for 15 to 30 years. For this profile, prioritize the lower APR. You have the time horizon to make buying discount points highly profitable, and you should actively price out a 15-year term to secure a massive return on investment. The objectively best mortgage offer does not exist in a vacuum. It is a personalized math equation that relies entirely on your timeline. Collect your official loan estimates from your lenders, be ruthlessly honest about your actual holding timeline, and stop guessing. Plug your precise numbers into the free mortgage comparison calculator linked in the description below to unmask exactly what your loan will cost. And if you want to master more of your personal finances with accurate, no-nonsense tools, hit the subscribe button for MiniWebTool.